Thank you, Michael. Thank you for bringing us all together here. Dr. Singani, always a pleasure speaking with you. Thank you again. Again, my name is Joseph DiMatteo, President and Chief Executive Officer, JDM Capital Hospitality. Started the firm, founding partner approximately 18 plus years ago. Been lifetime in real estate, bulk of it in hospitality, where my passion lies. And we've been pretty focused on, poorly focused on hospitality as a firm for the last 7, 8, 9 years almost now. So losing count of time, especially the last couple of years everyone's been dealing with and seeing. We deal a lot in select service and above assets, focusing in on an asset management approach to deal to our assets. And as well as, I think one of the things that differentiates us is our expertise and knowledge of food and beverage, our ability to kind of differentiate that even from other, even owner developers. Some people shy away from that. We kind of embrace it. And I think that from the project management perspective of us being part of a development team and having been, everything from GP, co-GP, pref equity, participating mezzanines, really kind of the areas that we kind of play in on assets, pretty much in select areas that we think that there's opportunities. So I think that what we're seeing today, to answer the last part of your question, is that I think that everything is a very strong asset play. And I think that the idea is to not be so afraid of the lack of cash flow and no acquisitions. And I think that you have to look at it in the terms of seeing inflation where hospitality is lagged. And I think that that's been the absorption into the ADR of all of the influxes of inflation that has happened. So where you've had increases in costs from material, food and beverages, where you've seen increases in labor costs, that hasn't really trickled into the full breadth of what an ADR can absorb. You've had static to lower rates to pre-pandemic levels. And though those costs have gone up internally, they haven't really been absorbed by the consumer. So when you look at a hospitality deal today versus 2018, 2019, even if you're looking at the reflection of the revenue drag, you can't. You have to look at the occupancy and the asset itself. How much is it going to take to get it to either be repositioned? How much is it going to take to be able to get it back online? And how is it going to take to go forward? So it may be stress, but it's not necessarily distress.
All right. So thank you both for the introductions and some backdrop for our conversation today. I want to start macro, big picture, and then, go bottom up fundamentals. So what's the big picture story for the hospitality space? Sorry about that. What's the big picture for the hospitality space going forward? How has it changed? How should investors be thinking about it today? Right? How can they get exposure safely? Like, give us what's going on inside your heads when you think about hospitality.
So I can probably start and then love to hear Joe's views on it. First of all, almost everybody has gone through a rough patch with hospitality since COVID, except probably very boutique hotels, which were resort places, and the wealthy people just decided to go away from all this chaos and pay whatever it takes to be there. So like Aman Hospitality, which is normally, I believe, is 40% occupied, they are 95, 97, 98% occupied, and they've done very well. But if you take that sector out, the rest of us have all lost significant amount of money during the COVID phase. And especially if you had a CMBS debt, that's a killer. And it almost has made me feel like I'll never do CMBS debt again. Even I'll pay a quarter point more for a regular debt. But we always, when we are all emotional, we say stuff like this. and I'm pretty sure I'll end up doing some CMBS in the future too. But it is a very frustrating time that CMBS just never got into it and to help people to go through it, and they really killed people with fees and fees and fees everywhere where it was not necessary. And we knew that the cost wasn't there. Just to extend something for 90 days or 180 days, it doesn't cost 1% of the loan amount. If it's a $20 million loan, it's $200,000 fees just to give it that extension where the whole world had come to stop. But be as it may, I'm sure I'm just sharing with everybody else what they have suffered. But having drawn a very bleak picture, suddenly there was a shining on the dark cloud, and that was from April. We have been cash flow positive. We have been producing well. Some of our hotels have even gone back to 2019 numbers, but even the hotels which are in the major metropolitan area are still suffering because the conventions just haven't come back. And just when we feel that the COVID impact is going away, and Joe will agree with me that the convention business takes anywhere between 90 days to almost a year for people to book. And just when we think they will start booking, Omicron shows up, or the Delta shows up, or somebody makes some statement, and everybody then pulls back. Apple doesn't want to go back to work at the offices. Google pulls back. Amazon pulls back. All these major companies pull back, and that impacts the psyches of the people. And they again have an issue doing it. But having said all those things, overall, we are still positive in cash flow, and we believe that once these restrictions are going away, which initially my projection was fourth quarter 2021, which partially happened, didn't happen to the full-fledged. I thought it would be by this time we won't be wearing masks in the airlines, and we won't be wearing masks anywhere. And that's yesterday, New York just put masks inside and outside. And I can't understand the rationale behind it, but that's a different discussion. But going back to your question, what do investors look for investment going forward? Listen, hospitality is an integral part of economy. It is not going to go anywhere. There are some disturbing factors which are all temporary. So I would strongly recommend that whatever you have, please hold on to it. Do whatever it takes, but do not lose your asset. If your asset was performing in 2019, I almost guarantee you it will perform in 2022. So that's first advice. Or who am I to advise? I mean, I'm just learning, but the first observation. The second observation is right now, just like Joe mentioned, there is no distressed assets. We thought when all these things started that we will get assets worth $1 for a few cents. Well, it hasn't happened. Even the dollar is actually appreciated to $5 for no reason, or $10 for no reason. It's very, very hard to find a discounted hotel purchase as far as we are concerned. Now, I think you had in the last meeting, you had somebody who had done very good acquisitions in hotel industry. So I'm not privy to that, but at least I have not been able to do any acquisitions because the pricing just doesn't match, and either the debt is not available or the equity is not available. It's a big balance that to happen, but I think it will all flourish as soon as these temporary restrictions go away, and I look forward to that happening in 2022. So my only recommendation would be for the investors, which was your original question, is save the money. If you can find something at the good price in hospitality, go for it. Otherwise, wait, and your time will come. The sector is robust. It will never going to go away. People are going to travel. People are going to travel for leisure. People are going to travel for office. I already have people coming and visiting me, which they could have easily done it on Zoom, because now it has become a competition. If two people want my business, then one guy does on Zoom, and the other guy finds out that the other guy is flying to see me, well, the Zoom guy flies in to see me too. It's a competition, which is what the sine qua non for this country. And that competition will make us do more than others. Nothing replaces to take a bite at the bread at the same table for lunch or dinner to do a better business or play a golf game together or things like that. So I'm going to shut up at this time. I think I took over a long time.
Very well said. Joseph, any thoughts, any insights that you like to share?
I really
disagree with Doc on?
Well, first off, the CMBS thinking, he and I are part of the same help group in regard to feeling the same way about CMBS. I hope that our despondent nature towards it will open doors towards it changing the things that are needed to be changed for it to be functional. I think that it works well for only one way. To absolutely be able to perfectly time an exit or not assume any problems without any method of proper method of being able to cure problems. There's got to be a more borrower, because the CMBS structure, so much of what they have is so safe. And if they're in circumstances where there are deed of trust states and there's nothing stopping them to be able to get at the asset, the idea of the CMBS market was to create stability, not to create a predatory lending environment effectively for commercial borrowers. So I think that it's a tool. If you've got a net lease, that'd be a great asset. You know when it starts, you know when it ends, and you can be able to work your way towards a clean termination. But life is just not that way. So I think that there's changes that need to happen within the structure to make it more borrower friendly and less, borrower hurtful in regard to what they are. In regard to what I think today, I really seemingly, I think in the last few weeks have come along the side of, I think it's price per pound. Buy as much as you can for the right price per pound that you can in the right market that you can. I just don't think that it's not a build it, they will come. It's just a fact of nature. If you are buying within a reducing supply market, if you're buying within a market that's not completely dependent on a unifocus of just strictly business, of strictly just leisure. If you have a vertical integration, I think that hospitality is going to be a key component to leading all mixed use development, whether that's vertically within buildings, where you'll see markets being more open to more zoning changes. I think that as you see markets that are closed off at the moment. I mean, I remember the day when, many years ago when they sold the Four Seasons on 57th Street in Manhattan, and it was like $543,000 a key. And I was like, oh my God, how could anyone ever pay for something like that? The markets in Never Neverland, you probably still would pay, almost $2 million a key for that asset today. And the cash flow doesn't support that. And that has to do with the bricks on pound mentality. And I think that this is a value player's dream and they just haven't realized it yet. I think this is where your opportunity is to be able to realize the increased expenses, to be able to get into a market, to be able to rehabilitate physically an asset. So that will take the asset either offline as the market starts to catch up. So you can invest into new infrastructure within the project, new elevators, or you could be able to take up a strategy to be able to reposition those keys, make 150 keys into 100 keys, make 300 keys into 150 keys. This is the time to kind of do it. And by the time we are on the other side of it, consumers are going to be faced with the unveiling of what was no longer just 6% inflationary costs of raw goods, that have been basically hidden by being offshored. That's now being hit. I mean, that's really what's happening and part of the reinflationary economics that's happening. We've constantly had, if you've looked at things over since even the 90s today, a kind of hidden 4 to 6.5, 6.8% inflation that's been offshored by acquisitions of products in overseas versus domestic acquisition. And if you look at the supply chain break, you look at the changes that have happened from availability in consequence of what's been actually been able to be produced. And it's the materials that are being shortchanged and the access to that. So when you look at that and you say, if you could take a hotel asset offline, do something better with it, come up with reimagining it, whatever you want to be able to do, a price per pound asset base, a value-added player is going to really sing in the 2, 3, 5 years, 8 years out. You got to look at hospitality with a longer term perspective than you probably did before in the past.
Great. So, you guys are talking about debt, right? You're bringing up CMBS, and you're not happy with how they've negotiated. They haven't been fair. With
It's a general market specific, nothing specific to anything either of us have gone through. Just friends and family, close relatives.
Banks, investment banks, they get it wrong all the time, right? They're typically investing when they shouldn't be. They're not investing when they should be. So what I'm hearing, what I'm learning from you guys is debt in the hospitality space is tough to come by these days. Is that a fair statement?
I think definitely that debt is more difficult to come by. I think that the debt funds are more the place du jour at the moment. There are some banks that still are out there as relationship driven, and not to beat up on general banks, I think those are ones that helped, where banks didn't get it wrong and they helped their borrowers that were good borrowers that realized that this was a tsunami event. This wasn't something that was ill-fated or ill done by any borrower. I think that's what the contrast really is between the CMBS concept and the general banking world. I think the general banking world, where there was banking debt, said, listen, we're all going to work through this together and we're going to make it out the other side, because everything was performing before this event. How can we help you get to that other side? So I don't want to beat up on the banks too much in regard to where, in the past they might have gotten wrong and been overweighted and miscredit balanced. I think that they did the right thing to protect their balance sheets overall. You haven't seen any banks go bad. So we can't beat up on them that much in regard to that regard. I think the banks that were valiant in the last market, that were more pro-development, were rewarded for it. And I think that they still remain to be rewarded for it because some of those assets haven't been able to come online or have been delayed to come online. I think that it's the stringentness of the CMBS market, of what it's not flexible to be outside of the box of which it is, in regard to that concept. So not to beat up on the banks or the debt markets, I think that, yes, it's not available. They're all trying to consistently reassess something that no one can been prepared to reassess for. But the banks have been more friendly than the CMBS market. And I think that's a general contrast. And the availability, it's relationship driven, I think, at this moment, and also on a much smaller side.
So Doc, do you want to take a stab at that?
No, I mean, I fully agree with Joe, and then there's no point crying over a spilled milk, right? But I think when we rolled out trillions of dollars for the economic stimulus, we missed out on this one major factor. Hospitality is a huge, huge chunk of economy. And if we had just done something about the CMBS debt, I think the hospitality sector would have recovered a lot faster. And those kind of things, we had a president who was a real estate guy, and now we have a president, and they all see the devastating impact of this CMBS. Like Joe said, it's a predator. It is unbelievable how they have treated people in these circumstances. So I wish there was some better mechanism was put in place in the rescue financing or whatever format they could have come out. So but it is what it is. Hopefully the administration would have learned from this, and next time they won't make the same mistake. The existing debt obtaining is even for a seasoned player. We believe we are a seasoned player. We are not the largest player in the market, but we are medium sized. And even we have problem finding debt of relationship, because they want to maintain the relationship with us, they will come back, but they will give you some stupid terms like they'll fund 50% of the appraised value, or loan to value would be like that, or the interest rate would be 5% or 6%, stuff like that. So they just amuse us. But it's just like Joe said, hey, listen, if you can buy something at the reasonable price, we can buy something at the 2020, 2021 NOI cap valuation, shoot, go for it, because it's only going to go up from here.
Right. Definitely see it that way. If you've got a good basis that you can get off from, and I think that that's one of the things reason I think that deals have been trading. I think that those buyers are definitely forward buyers. You can't look in this business as a 24-month turnaround. It's too unpredictable at the moment. And I think that the side of where there's been, there's need for more support. Back to the concept very early that Dr. Singani said, is that where you're seeing the convention business still hobble along, and that group business is, very mercurial. It's very, it's like it's a cat touching the water. It's very cautiously doing it. The booking window. Please.
Talk to me about best ideas. Best
Sure.
ideas today. Even if it has to be done with a creative structure. Talk to us about what's on your mind on how to alleviate the concerns of the investors while being able to acquire an asset at a good price, and there be upside for both you, the general partner, and the limited partner investing alongside of you.
I'm extremely excited about the concept of playing the length of stay game. What does that mean? That means that we want assets, and we feel confident that where there's assets that we could be able to offer a longer term stay at these as a part of not maybe the full asset, doesn't need to be a full like residence in, but the idea is that there are heavy components towards having kitchens, light kitchens, the ability to be able to have these facilities where people can feel at home. Because I believe that the changes from the office market are bleeding into benefits for the hospitality market. So where you have 50% of the population that may be going back to the office, and there's a desire to be, yes, people to meet, fly to go meet one another and so forth. I think that there's 50% that's another very split piece, where I think that people are going to be living a bit like a sundial.
I have some good data points, like locally, of people in Miami. For those of you that don't know, I'm in Miami, Florida. There's people here that are on consulting gigs. They're here for quality of life reasons, the fact that they can work from home. So I do believe that what you're saying supports these themes. And what we're seeing here is they can't have longer stays because the price fluctuation, the price volatility. 1 week it's $100, the next week it's $700, right? So I definitely like that idea, and I see real live examples in our community locally.
Yeah, I think that it's going to be as an example of many. One of our attorneys that we work with is January through April next year. He's a partner in a law firm. He's already planned. He's rented a place in Delray, and he's down there for the next 4 months. And I think that there was an article that came out in the Times not that long ago that basically stated that people who, let's say, fled to Florida turned around and said, like, well, it's hot all year, but you know what? This is part of my life now. And they're looking at it and saying, I don't want to own a place because that's 8 months of responsibility, but I'd like to be somewhere for 3-4 months here. And maybe I want to go spend ski season in Idaho for another 3-4 months. And maybe then that's my half a year that I'm back in the office and I'm closing out the year there or something in that regard. I think that the cat's out of the bag, not to refer to Dr. Singani's cat, but the cat's out of the bag in regard to the fact that people have learned this new lifestyle. And have come up with this concept of wait a minute, we don't have to live this way and still be functional. We've proven that we can work this way. And I think that some people are just not going to go back to that world. I think that the office market is going to have to reinvent itself. That's a separate discussion, and we could do another one on that. But I think it's massive opportunity for the hospitality sector. If you have the ability to be able to create projects that have transient and both longer term stay opportunities, you will have an amazing opportunity to be able to play the world dial, whether it's the South American winter in July, that you're going to be able to now get a better business model from July to September, maybe in October, early October, into the Florida market as an example. And you're going to be able to get good rates because they're not going to want to deal with that 100 one week and 500 the next. All the hotelier is trying to be able to do is hit an average. But if we can contract that average at a high rate and deliver a great service for it, you're able to give them furnished units. They don't have to be able to buy anything. You're giving them an accessibility to either control their food, either be able to go out and buy it, have it delivered to their room, and have that flexibility, as well as do their work efficiently with high-speed internet. If they want people to meet them there, what a unique angle that, hey, wait a minute, Dr. Sangani's in Florida this week or the next 3 months. I know I'm going to be down there too. You know what? I'm going to plan part of my life to meet him and do business with him 2 weeks that he's down there, because I'm going to be down there too. So that uniqueness of that open woven lifestyle is just not changing.
So Doc, you're a forward thinker, right? You're a creative structurer. When you think of hospitality, what's your solution here? Best ideas to actually, realize some interest and to get things moving, to get things flowing in the right direction again?
No, that's a good question. But just to make a comment on Joe's comment about my cat somehow has this obsession that she must show up on every Zoom that I'm on, and then he leaves. And I got a lot of comments back by saying that it was nice to see your cat, much more handsome than you. So I let that happen. I hope I have not offended anybody with the cat showing up in the Zoom meeting. But
no. I was going to borrow my neighbor's dog, to be honest. I was a little jealous. I didn't have a sidekick.
I'll lend you one, Joseph.
Thank you.
So going back to your question, listen, and you know me for years now, and you know me very well. I'm a very, very conservative, aggressive guy. And it's a very complex statement I just made, okay? What it means is that you need to be aggressive when you can be aggressive with a proper fallback mechanism. Otherwise, you should always stay conservative, and you always should not be aggressive for no reason. So everything what Joe says, I 100% agree with it. At the same time, the conservative guy in me is telling me, to your listeners, and I see lots of them on the call right now, my only request to the listeners is, if you haven't been in hospitality business before, this is not the time to get in there. This is pros world right now. Because just like Joe said, you got to manage so many things, debt, equity, what the future looks like, what am I paying for this? What upside is going to happen? Is this going to be where people are going to show up in the future? Is this where office market is going to be impacted? Is this the place where just a transitory renting will occur? I mean, just like what Joe was mentioning, there are too many complex mechanisms those are playing. But this has now become a totally pros game in hospitality. If you did anything in multifamily between 2011 to 2020, it doesn't matter. You could learn the business because you cannot go wrong. If anybody lost money in multifamily in the past 5 years, they really did not need to be in business to begin with. So hospitality was like that before 2019. It was hard. If you just follow certain check marks, it was hard to lose your shirt. But this is a pros game. My request to the listener, if you have never been in hospitality business, this is not the time for you to go head in first. But if you are a pro, then to push it is how aggressive do you want to be? And then you will be successful eventually. Everything, almost everything I can say, if will go above 2019 level very soon.
So what are the structures that you guys are considering today for people to co-invest alongside you?
I haven't done any deals in hospitality for the past 16 months or two years. Now, what I'm doing right now is, you and I had talked about it, is we are, when, you know, when the best way to find out whether you should be selling or buying is when you can't find the enemy, you join the enemy, right? I haven't been able to buy anything for 16 months or almost 2 years. Now, I did buy something in the first quarter 2020. So I haven't been able to buy anything for almost 7 quarters. So what does that mean? That the prices have escaped me. So what I'm doing right now is I'm taking my hospitality portfolio and I'm in communication with 2 groups. My portfolio is not big enough. It needs to be about $2.5 billion. I think we are close to $750 to $1 billion portfolio in our company today. So get it to $2.5 billion to go public REIT. And that's what we are exploring. With 2 groups, we are exploring to join our groups together and go as a public REIT. And all these listeners, if anybody wants to contribute their asset at the ground level to go to public REIT, we are looking for more partners to do that. That's the strategy I would employ right now to get, market is hot. How can I cash out? How can I do something different with my assets? Or I can wait for another 12 to 24 months, just like Joseph was saying. And then I know it's going to be back to 2019 level.
Doc, thank you very much for sharing that. That's very interesting. I'm gonna, just for those of you that want to reach out to him, I'll be sharing his contact information with you after the presentation today. Joseph, what are you doing to be open for new investors, to be open for new opportunities? What are the structures that you're considering?
It's a great question, one that we've been exploring. We're probably behind the gate of where Dr. Singhani is, for sure. He's a trailblazer when it comes to these structures, for sure. And he's the oracle of these things. So I kind of look towards him to hopefully learn. But from our side, I think that there's I feel that there's some confusion for companies of our size. I think that there is a concept of a merger of parts that might be something that's in the wind of discussions. I think that there is an opportunity to be able to look towards another private equity vehicle or look towards another kind of public vehicle. And I'm not trying to be evasive. I think that I can't at the current moment read the tea leaves of the market. So what's giving me the lead concept is that we're looking by the deal and then looking by the structure after that. We're kind of trying to let the opportunity lead the structure, because I don't know if a fund that's in a 3 to 5 year life cycle fits a 5 to 10 year decision on some of these investments. So I don't think that there's enough of a bulk of volume of new work to be able to match a strategy. So it's kind of like find a deal and the money and the structure will follow for us at this moment. I don't think that we have an answer. We're open to ideas. We just haven't found a good marriage or a good structure that's going to be beneficial for us at the moment.
Have you guys explored, either one of you, like crowdfunding, to see if some of these new trends in crowd funds is working and would attract capital from investors?
We haven't seen much of hotel activity on crowdfunding. I haven't been very successful in crowdfunding, although I was very initial investors in all those platforms, which have now become billion-dollar companies. But one of my friend raises about $80 to $100 million a year from Dallas, Texas. And I was just having lunch with him last week. And he's still raising, but let me tell you, everybody and their brother is after multifamily right now. You put a multifamily deal and it gets subscribed in one deal. He said he got subscribed in some 41 minutes. But hotel deals, I'm not aware that they are selling like a hotcake at all. But I'm not that much into crowdfunding because I've not been a successful money raiser at crowdfunding platform.
We've never entertained it or kind of explored it because of a multitude of reasons. We just didn't feel hospitality fit that risk profile of that of finding maybe that profile of that investor that would understand the business enough and not understand the complications. I think that it's just not something that lacks sophistication, maybe perhaps for crowdfunding purposes, but we've obviously read the books, the papers, had multitude of meetings with platforms, but we have not engaged or taken 1 cent of that channel so far.
You know, like I find that interesting, and I also find that you know, to be one of the reasons, you know, why you shouldn't think about doing it. You know, there's a democratization movement on a macro level to give people exposure to asset classes that they didn't have exposure to in the past. And the fact that you're saying that makes me think, hey, it's probably a great opportunity to raise some funds in that space.
As long as it's not punitive to the sponsor. And I think that's the step case in regard to some of these. It's something we always open-minded. We're not closed-minded. I don't know when, that's not my expertise of knowing that structure and how it works, but enough of it to, as long as it's not punitive to the sponsor for, we establish the risk, they understand the risks. Too much of the market has become like buying a toaster. I don't like it. I want to give it back. I want my $35 back. And, that's the concern for us, from a sponsor perspective and looking at it from that side.
Absolutely. So let's go into social.
Sure. Oh, that's huge.
So we started talking about some social changes in investing. Let's go into social decision-making choices when selecting a hotel to stay at or not. What are some of the trends that you see happening in the space?
So I think that I'll start off, if you don't mind, Doctor. The idea is I think you've kind of got 3 levels. One is on the higher end perspective, you're seeing the full array of freedom for all to obviously highly clean spaces, nightly room cleaning services and so forth, to a bulk of the select service market that is a hybrid of that, with still a lot of human contact, and then the limited service where there is a high degree of increasing of, let's say, touchless contact, where that's to some extent becoming a little bit more popular. So I think that the CDC guidelines for the select service side of the timing that's involved, and a lot of the consumers just either don't understand it or don't get it, that you're supposed to wait a certain amount of time before the room is re-entered. New York and the union rules that are there are very prohibitive in regard to how that works, and you can be in a cycle of almost 3 days before technically a room can be put back online. So every market is very complicated in regard to that, if that's the piece that you're touching on socially. But I think that the decisions of the socialization of why people are going, and extending their period of time, they definitely are. Those travelers seem to be a little bit more demanding, a little bit more knowledgeable of what they're looking for. I think that they are not as fluid in regard to the price point, because it's pretty blended at this point. I think that there's a commoditization at this second that the consumer is benefiting from that's not going to stick. That reinflation hasn't hit Oh wow! If you looked at what happened, the airlines tried to lead the charge in September, and they massively tried to increase in that late August September timeframe. All of a sudden, the airline costs jumped to be able to get a ticket because everybody was getting this whole reinflationary market, and it didn't happen. And they went back down in October, and they started to recede on that thing, and you can find $38 flights again. Well, there was probably a 45-day period that didn't happen in August and September. And I'm not sure, it might have been something we talked on privately, even with Dr. Singani back then, that had happened. And this reinflationary factor has not really reared its head into the inflation. It's happened in residential rental. Look at the prices in Miami in regard to what it costs to be able to rent an apartment there. Look at the condo costs that
Yeah,
are
but
increasing.
it's happened in the hotel space in Miami, big time.
Well, that's two reasons. One is because there is a constriction and people are transient because they're trying to come down there to try to find jobs. They're playing the game. So they're still working for company X in New York, but they really want to live in Miami because that's where everyone's going. There's a lot of weird reasons of what's happening and why that's happening, but that's a small market segment, but across a national scope, you can still find a $100 a night place almost anywhere, and not a horrible place. You could stay at a full-fledged JW Marriott to a Sheraton for $110, a night in any given midweek. So you take that and maybe you're getting hammered on the Friday, Saturday nights, because that's where the hotels are trying to make back that money. But go try to stay somewhere, even in Miami on a Monday, Tuesday. I think you'll be pretty surprised at what you see in the average blended rates.
Doc, you want to add on to this? Any?
No, he's very correct. I
insights?
think the inflationary pressure, even our Five Guys, I mean, we have raised our prices for the burger, and our average ticket is now $19. Think about it, $19 for a burger, but people are paying it because there's no other choice than us to increase the prices. The inflation has really gotten out of control. We just haven't seen across the board, just like Joe says, increase in the hotel prices. Now there are bands of dates. Like we have a hotel in right inside the Brave Stadium, the Battery Park, and during the game, hell, we'll sell it at $300, $400, $500 a night. But that doesn't happen every night. The other days, just like Joe was saying, you can get the room at $100 a night. So but if you really look at the hotel industry, it has never really kept pace with inflation as much as it kept pace with demand and supply. So I'm not surprised that the prices haven't gone up, but I know as soon as this airline mask thing goes away, and as soon as as soon as these people start booking those conventions,
That's right.
the world would be so different at that point, and then you will see the jump so it will catch up with the inflation. Right now, it just doesn't have enough room to catch up with the inflation. That's all.
That booking window is so key. What Dr. Sangani is talking about right now, we went from 6 months to 9 months booking window to 6 days. To if you look at like the hotel tonight statistics on the hotels, 90% of the bookings are with that day. So that just tells you everything. You still have a heavy drive market and less dependency on the airlines. But I completely agree. As soon as you start to shift and change and you remove the mask mandates on the airlines, and this starts to loosen up, the supply will be reabsorbed. The conventions will come back. All business travel is going to be different. It's going to be longer length of stay, but I still believe exactly what Dr. Sangani said. And then you're going to see, for once, the reinflation. You're not going to be able to see a $100 hotel night. That'll be a thing of the past. That'll be something you win on a gift certificate at a church raffle.
Guys, I feel like I live in an alternative reality here in Miami.
It's the perfect world, Michael. That's why.
All these things that you're saying are not my experience and what I'm experiencing. I'm experiencing, Art Basel. I'm experiencing high room rates. I'm experiencing a ton of people in town. I'm experiencing a ton of people requesting in-person meetings. It doesn't seem like anything changed. I'm just
You're the
like,
promised land. You're the fountain of youth. This is one of the hottest places, if not the number one state location place for companies and people to move next to Texas. I mean, Gordon Ramsay moved his entire food and beverage operation, just announced this week, from California to Texas. Texas is second, but Florida is like the number one place, Michael. It is where companies, people, everywhere people are shuttling to because they feel the most free, the most. Look at New York. Literally, the churches sent out an email across the state from the archdiocese saying that everyone has to wear a mask inside and outside of a church. The government is reaching inside a place of worship, and that's pretty. Just put it out there, and you think that white people aren't running to Florida? I mean, it's just a cause and effect, a factor. People are just afraid of their liberties. It's not even being afraid of corona. That's a whole other issue, but it's a social factor. Regardless of what, I'm not saying about vaccine or anything like that. I'm talking about what these actions do to people's decisions in their life. You can't ignore them. But that's the promised land.
so talk to me about the fundamentals of occupancy, room rates. It seems like it's following the typical real estate model where it's not a national market, it's a
Local.
local market.
Yep.
And
Totally. If you're next,
are there any themes? Are there any investable themes inside of these trends that we're discussing?
Going back to, yeah, I'll just take that, but I want to still make a comment about Michael, what you said in Miami and the rest of the world and living in alternate reality. I was in Fort Lauderdale yesterday and just came back to Dallas last night. And you are very correct. But if you think about it, just what Joe said, Florida never believed in mask. They approached the coronavirus, in my estimate, and as a physician, I can say that they really approached it the way it should have been approached in the rest of the world. And you haven't seen any difference, and that's why people feel that comfort to going to Florida and what is happening. But that is really not the case across the country. Just it's not only churches, it is everywhere in New York city, I think it is state too, that you have to wear a mask indoor and outdoor from Omicron. Well, have we figured out what Omicron is? Hell, nothing bad has happened as compared to that. So the country is going through a revolution right now again of this fear.
So basically what you're saying is there should be a premium on hospitality assets located in states like Florida and Texas, states that have a more consistent policy on no masks, being open for business.
I think that's it. The open for business, the ones that don't feel that people, I think that is threatening, what people are perceiving to be personal liberties. I think that there's it goes against our natural internal hierarchy to be, we're tribal in our sense that we need to be around people. And I think that the separation of that concept is can't be underweighted. And I think that, yes, I think that that premium is going to be paid because people are going to be, even if this changed in 6 months, I'm not sure that people are going to feel confident that New York won't do this again or won't let off of this. There's not a sense of assurance between the new mayor or who may or may not be the next governor or this governor that's there, who may or may not be, and I'm not saying anything negative. I think that they're just taking political stances that there's a cause and effect question here. This is not me making a political statement. It's just cause and effect. It's fact. So I think that those premiums are going to be there. And yes, I think that people should be paying up for those markets because
it allows you to plan. It allows you to model.
It's a part of their life. There was a great article that said, Florida may not be where I want to be all the time, but it is now part of my life.
It's part of the portfolio.
It's heavy. That's a heavy statement.
They want to spend some time
and they're not doing it when they're 90. They're doing it now.
It's not new. And then you also add on work from home. And one of the trends that I've seen is a lot higher incomes locally. It used to be a problem with income where, you'd have this beautiful place, nice buildings, nice condos, nice high style of lifestyle, but there's no opportunity to make a decent living, right?
Almost anybody who wants to get a job at this point can fly to Florida and will be hired in 36 hours. There is a job for everyone in that state. There's a massive need for employment.
So look,
As an owner and operator there.
we have 3 minutes left before the next panel. I'd like you guys to do some closing statements, arguments. What is it that you're looking for? What is it that you want? Let's put it out there. This was a great conversation today. Let's finish strong.
Okay. Joe put me out in the front, which is which is just fine. And I really, no matter how and what people tell me, the person who is conservative in me is again going back to the same chapter and saying, if you have not been in hospitality business before, you do not have enough experience in hospitality business before, today is not the day for you to learn this business. So please, please, please be careful when you put your hard-earned money out there. So that's number one. Number two, hospitality business is here, is going to flourish, is going to do great. We just don't know whether it is going to be 1 month or 12 months. I was very positive a year ago that the fourth quarter of 2021 would be almost normal, and I'm dead wrong. And I hate to say that I'm dead wrong is not because there was something wrong in my prediction. We just haven't learned enough. And then every time something happens, we are putting these restrictions that's causing it. So I lost confidence in how we are going to react to new hate or lack of better word, new news. And then because Omicron, there'll be something else. This is like a flu virus. It's going to be with us. It's pandemic. It's going to be with us for the rest of our lives. And most likely, we are going to take this vaccine every year. So I don't know when we are going to accept this and not keep worrying about it. So I'm going to shut up at this point and just tell people, great business, hospitality, it will do just fine. The inflation will catch up. The prices will catch up. All of these things will catch up. We just don't know when. So be careful when you enter and what price you enter.
Joseph?
I think that I double down on everything that Dr. Singani said. I'll add on the fact that the underlying piece to that for me is that it's a long-term business. I don't think that the idea is that some people are come in and do it quick in 2 months that you're going to make all this stuff is not the case. I think that you have to have a long-term perspective, and you need to work with experts in the field to be able to be as prepared for what may or may not come, and for all of the difficulties that reinflationary factors can bring. But I think that it's still a good buying season overall.
Guys, I appreciate your time today. I appreciate you coming back, and I look forward to your developments. I'm privileged to call you both my friends, and if I don't get to talk to you before the holidays, happy holidays to both of you.
Well, thank you. And I just hope everybody recognizes what a great service you are doing for the community, and our heads are off to you.
Absolutely. Thank you so much, Michael. I so appreciate our friendship, and Dr. Singani, same there. Always a pleasure, and look forward to seeing you soon.